Good morning. This presentation will provide an analysis of the three potential acquisition targets for the purpose of J Sainsbury plc, authored by Richard Carter, George Emerson and Matthew Holder. The process of strategic acquisitions, mergers and alliances present a significant opportunity for companies to augment their competitive advantage within the market, through facilitating the resources and capabilities of both bidder and target to foster endogenous growth. However, it is critical that the target company's strategic intent aligns with that of the bidder. With this said, this representation aims to provide an analytical and evaluative approach towards identifying a viable target company for the purpose of Sainsbury's. This presentation will include the following objectives. Firstly, it will provide acquisition rationale, bid valuations and financing options for three potential publicly listed targets. It will eliminate unviable targets, selecting one target with the greatest value potential. Finally, the presentation shall identify acquisition bid strategies to mitigate potential risks of destroying value post-acquisition. Sainsbury's was founded in 1869 and has accumulated a market share of 17%, operating 1,200 stores and employing 161,000 staff. It operates 6 business units within its structure: stores, online, energy, banking, property and entertainment. Their strategic vision is to become the most trusted retailer, striving to offer industry-leading products and services at fair prices. The first potential target for acquisition identified was that of Tate & Lyle plc. Tate & Lyle are a global provider of distinctive, high-quality food ingredients and solutions to the food and beverage industry in 30 global locations. They operate 2 integrated business units in specialty food ingredients and bulk ingredients. Their strategic vision is to be the global leader in food ingredients and solutions. Now, rationale for this acquisition include that through supplier integration, Sainsbury's can use Tate & Lyle's knowledge capabilities to develop a competitive advantage at the product development and manufacturing stage. This will increase their operational efficiency, decreasing the production costs associated with economies of scale. Furthermore, it will allow Sainsbury's to be more price competitive in a sector becoming increasingly dominant through the emergence of discount retailers. Now, in regards to valuation, the post-acquisition value of the combined entity was deemed to be 33.35 billion, given their both respective market caps and the price to earnings ratio of Sainsbury's. Now, it is deemed necessary to use the bidder's price to earnings figure, as it is foreseen that this figure is highly unlikely to change post-acquisition. However, we conducted sensitivity analysis to determine the potential value range. We concluded a range of -38.8% to +42.7%. This high range indicates the potential volatility of the acquisition. Now, there has been a significant downtrend in Tate & Lyle share price in the preceding 3 years. Therefore, shareholders are likely to favour a takeover bid and minimal competition is to be expected from alternative bidders. Now, therefore, a conservative bid premium is proved adequate. Now, we concluded that Tate & Lyle's net asset per share value was £2.01. Therefore, this indicates the minimum that they were willing to accept. Implying a bid premium of 25% would imply a bid per share of £7.13, thereby indicating a significant margin upon which to negotiate. However, there is potential volatility for the transaction, as Tate & Lyle are family orientated and well established, which may increase hostility. Therefore, a bid increase of up to £8 per share will still prove viable. Now, in regards to the financing of the acquisition, it was noticed that Sainsbury's gearing is actually high at 26.74%. Therefore, it may be argued unsustainable to fund this acquisition through cash due to the increased risk of liquidity. With this said, a share exchange is proposed of 1 Tate & Lyle share to 4 Sainsbury's shares. Under this share allocation, Sainsbury's set to make a cumulative gain of 21.29 billion and Tate & Lyle shareholders stand to make 4.01 billion gain. Now, shareholders are therefore likely to favour such a bid, and the cash funds can be invested elsewhere to support endogenous growth. However, Sainsbury's shareholders will have to relieve some authority power and the uncertainty associated with valuing a share exchange increases the potential volatility of the acquisition. Nevertheless, the potential synergies and financial gains of this acquisition appear to outweigh the costs.
The second potential target identified for acquisition is B&M European Retail plc. B&M is a fast-growing discount retailer that currently operates 450 stores within the UK and in Germany under the J-Wall brand. Although they have only been listed on the stock exchange for 2 years, have expanded quickly and looking to expand even further throughout the UK and Europe. As a business, they have revenues of 1.6 billion, an increase of 29% on the previous year, and profits of 39.3 million. Their strategic vision is to become the UK's #1 variety retailer, focusing on key brands rather than their own label. The rationale. B&M currently operate in the discount supermarket. By attaining B&M, it will give Sainsbury's a larger share of the discount market and would help benefit competitive advantage. In addition, if there was an economic downturn, the discount retailers often see high levels of growth, thus providing Sainsbury's with organisational stability. Also, B&M have an extensive portfolio of products which will create value through the means of diversification. Also, would fundamentally provide Sainsbury's with access into the European market and Germany. The valuation. The current market cap of B&M stands at 2.73 billion, indicating a benchmark valuation of the company. The post-acquisition value of the combined entity will be 30.37 billion if the PE ratio of Sainsbury's stayed stable. However, a sensitivity analysis indicates a potential range of -39% and +42% respectively. This high range does indicate potential volatility. B&M shareholders are likely to favour a bid from a significant player in the retail industry, as it gives the company exposure to the consumer base of Sainsbury's. The current net asset per share indicates a value of 81p. This shows the lowest valuation that B&M shareholders are willing to accept. However, B&M shareholders could be reluctant to divest these investments through Sainsbury's, so adding a 30% bid premium onto the £2.73 would pose an initial bid of £3.55 per share, ensuring a total bid valuation of 3.55 billion. Should negotiations prove hostile, a bid increase of £3.82 per share would still prove viable. Financing. As mentioned, Sainsbury's operate very high gearing, which won't be viable for a cash or debt acquisition, as it will cause significant liquidity risk. With this in mind, a share exchange has been proposed of 1 B&M per share to 2 Sainsbury's shares. Under these conditions, B&M are likely to make a cumulative gain of 7.3 billion and a 14.6 billion gain for Sainsbury's.
Our third target company, Greggs plc, is the UK's largest bakery chain, demonstrating consistent profits over the last 5 years. They state that their strategic vision is to be the winning brand in their respective market. Over 1,600 shops in locations from high streets to transport service stations, Greggs currently compete in the fast-growing food-on-the-go market and are somewhat on their way to achieving their strategic vision by demonstrating consistent profits, operating on a zero-debt business model and achieving strong balance sheet results. The rationale behind the acquisition is due to the similarity of both Sainsbury's and Greggs products, as they both provide food to consumers, albeit in somewhat unrelated markets, providing several aspects of value creation to be realised. Firstly, the acquisition delivers value to both firms through cost reductions associated to scale economies by establishing operational synergies in procurement, distribution and manufacturing, as well as buying into Greggs' current vertically integrated operations, thereby decreasing the bargaining power of suppliers in the industry to provide immediate post-acquisition strengths. Secondly, the acquisition provides diversification qualities for Sainsbury's by gaining a greater share of the food-on-the-go market, providing a source of revenue enhancement. In regards to the valuation of Greggs, several methods were used. Firstly, Greggs' market capitalisation stands at 1.1 billion. Secondly, we then assessed the net asset per share valuation, indicating the absolute minimum which Greggs plc shareholders would be willing to accept, totalling at £2.48 per share and representing a total bid of 250.9 million. However, Greggs are a cash-rich company, displaying strong financial performance, and it would appear that for the bid to be accepted, a premium of 20% on the market cap valuation would be deemed suitable, taking the final bid to 1.32 billion, providing the combined entity with post-acquisition value of 30.35 billion. Financing. As the proposed bid premium of 20% equates to just 43% of Sainsbury's retained earnings, it may be deemed viable to finance the acquisition through a combination of retained earnings and debt finance. Through this method, Sainsbury's shareholders will retain authoritative power and do not have to relieve a portion of shareholders' funds. However, the gearing ratio of the combined entity will increase and consequently enhance liquidity and insolvency risk. The proposed share allocation is 1 Greggs per 6 Sainsbury's shares, and under this allocation, Greggs shareholders stand to accumulate a 3.96 billion gain, while Sainsbury's shareholders will experience a 19.9 billion gain on their pre-acquisition values. This factor is significantly likely to increase the favourability of the bid. We will now move on to the process of eliminating targets. With regards to target elimination, M&A theory suggests that for acquisitions to be successful, that the strategic visions of both the bidding and the target firms need to be representative of each other. The crosstab of our analysis reveals that Tate & Lyle is the only company whose strategic vision aligns to that of Sainsbury's. This is because being the global leader in the food ingredients market could complement Sainsbury's vision of offering industry-leading products to consumers for fair prices through the vertical integration opportunities. We'll now move on to target suitability. M&A theorists Wilkinson and Cannon suggest that the SWOT model can be used to perform a comparative analysis helping to determine the suitability of the takeover targets from the perspective of the bidder. The most suitable targets will help to offset the strengths and the weaknesses of the bidder so that they complement their differences. With regards to B&M, we can see that Sainsbury's strengths in technological resources can be offset by B&M's weak online presence, and also Sainsbury's high costs could potentially be offset by B&M's strengths endorsed by their great purchasing power. Analysis of the opportunity and threat alignment presents some difficulties, and although B&M's acquisition looks attractive, providing a potential entry into the European market, the threat from food price deflation is global and not localised to the UK, and therefore cannot be diversified against. However, this does provide an opportunity for Sainsbury's to hedge risks presented by the UK supermarket price wars. However, the threat of supermarket price wars can also destroy the venture's value if competitors use copycat strategies. The SWOT analysis of Greggs and Sainsbury's reveals that Sainsbury's weak bakery image can be offset by Greggs' robust brand image and strong bakery range, whereas Sainsbury's high costs can be offset by Greggs' no-debt financing model. Sainsbury's strengths in customer loyalty can also help to offset Greggs' low consumer loyalty, and this of course presents several opportunities and threats. Firstly, it provides Sainsbury's with market expansion qualities by gaining a greater share of the food on the go market. The acquisition will also increase scope and scale economy opportunities for both firms, and therefore can enhance learning economy opportunities for Sainsbury's financial department to be influenced by Greggs' tightly managed finance department. However, this venture prevents several threats, most notably from the supermarket price wars and food price deflation, as this will affect the competitiveness of the company and may lead for consumers to opt for cheaper substitute products. There are also potential food tax implications which may occur, again affecting the competitiveness of the overall profitability of the entity. In conclusion of the target elimination, whilst consulting M&A theory will reveal that both B&M and Greggs do not provide suitable evidence to justify M&A activity. Both of these options attempt to diversify Sainsbury's operations, but in reality they present too many risks which are associated to food price deflation and the supermarket price wars. However, the largest influencing factor is the misalignment of strategic aims, and in consideration of that visions do not align, Tate & Lyle provide the best fit for M&A activity for the following reasons which my colleague George will now explain.
Tate & Lyle have been chosen as the most applicable acquisition as they have the alignment of the strategic vision of that of Sainsbury's. This acquisition is known as backward vertical integration. By pursuing this type of acquisition, it will provide Sainsbury's with a competitive edge through technical efficiencies, will allow a greater control over quality and delivery of produce, and provide a more efficient way of coordinating production. This acquisition will allow Sainsbury's to seek economies of scale, as it will provide Sainsbury's with the opportunity to operate production on a reduced cost per unit basis and increasing their ability to compete efficiently on price. Sainsbury's will also benefit through economies of scale, which is referring to the cost saved on joint production. These economies of vertical integration will avoid the duplication of fixed costs, increase communication capabilities, bring added benefits to the consumers through quality and price. This will also help to diminish transaction costs. This states it is in the best interest for the company to engage in a make or buy decision, and in the case of Sainsbury's and Tate & Lyle would be a make decision. This vertically related production process will allow the integrated cost of production, competencies and avoid bargaining problems through the buying of products, therefore creating an adaptive, streamlined business model. This acquisition would also benefit Sainsbury's through learning economies. It allows the supply chain to become more efficient and effective, allowing the firm to utilise resources and promote lower costs. This will also provide Sainsbury's with a competitive advantage achieved through Tate & Lyle's knowledge capabilities, especially regarding product development and manufacturing stage. Tate & Lyle sell a variety of goods to various markets. This diversification strategy allows Tate & Lyle to operate a more efficient internal capital market. Sainsbury's can benefit by creating a larger revenue stream and thereby mitigating the risk of market variability. The acquisition proves favourable for shareholders due to the subsequent factors of efficiency improvements, strategic enhancement in market power and the expansion of internal capital. This will provide synergistic benefits and help create capital. Due to the Competition and Markets Authority state that the proposed acquisition is likely to be favourable because it will benefit the consumer through price competitiveness. Also, the acquisition of Tate & Lyle should not breach any market regulatory implications.
To drive post-acquisition value creation and mitigate the risk of destroying value, an efficient bid strategy is critical. With this said, the acquisition strategy for Sainsbury's and Tate & Lyle will comprise of 3 sub-strategies: pre, during and post-acquisition. Now, in regards to the pre-acquisition strategy, and due to the nature of the share exchange, we propose a state-building process within the target. This will place pressure on the target to negotiate and increase the probability of securing a major role within the bid. It may also deter competition from alternative bidders, potentially increasing the ease of the transaction process and creating scope for Sainsbury's to negotiate a favourable bid premium. However, this strategy may indicate the aggressive nature of Sainsbury's, which may consequently force the bid premium up. Now, UK law states that individual share bids in excess of 3% must be disclosed to the market. Furthermore, they state that should the total bids within a 12-month period exceed 10%, then they may have to be paid for in cash at the greatest price paid. With this said, it is advised that Sainsbury's accumulate 8% shareholding in Tate & Lyle within 12 months at 4-2% intervals. Now, the mid-acquisition strategy focuses on the ease of integrating the business operations of both respective companies in order to maximise the synergistic values of the combined entity and mitigating the risk of destroying value through a hostile acquisition. Now, formally, the management and ownership structure will need to be reformed to accommodate the Tate & Lyle shareholders. In addition, to align strategic focus, the organisation will have to be restructured, focusing on the strategic vision of striving to be the best. Individual business units will strive to create cost efficiencies that can allow Sainsbury's to compete to a greater extent within the price competitive industry. Now, both respective companies have a centralised organisational structure that consequently eases the integration process. Now, in consideration of the post-acquisition strategy, it must be an approach that will culminate in the positive exploitation of the available capabilities in order to secure a competitive advantage given the cultural context of each relative company. Now, Weber's 2012 model of integration process outlines certain strategies that can be adopted in relevance to the degree of synergy and the organisational cultural difference. Now, in respect of this acquisition, an absorption process is advised due to the high synergies and the low organisational cultural difference. Now, this process ensures that the company must combine all operational resources to eliminate duplication of assets and maximise capacity utilisation. This will increase the ability for Sainsbury's to become price competitive and compete to a greater extent with the emergence of discount retailers. Furthermore, Sainsbury's may prosper from learning economies, transferring the knowledge and capabilities of Tate & Lyle to leverage their manufacturing and product development stage. So to conclude this presentation, Tate & Lyle fundamentally offered the best strategic fit for Sainsbury's, as both strategic visions align, mitigating the risk of destroying value post-acquisition. The backwards vertical integration allows Sainsbury's to benefit from economies of scale and diminish costs. Therefore, Sainsbury's can compete to a greater extent in the increasingly price competitive environment. Now, the pre-bid strategy proposed a stake building process in order to reduce the potential volatility of the transaction. The mid and post-bid strategies both aim to align the strategic focus, whereby an absorption strategy was proposed, allowing for greater capacity utilisation and for Sainsbury's to realise economies of scope. It will also allow them to greatly leverage their product development and manufacturing stage, adding value to the customers. Now, fundamentally, all these factors support Sainsbury's mission to supply industry-leading products at fair prices for consumers.